Hey, I really appreciate you joining this. I like to call this a conversation, if you don't mind. And I've been watching a lot of the stuff you've been doing, and I'd like to take maybe a slight angle on this, and because you do a lot of this stuff, and I would like to really understand a part, if you're willing to understand a part of your career, like how did you end up where you are today? And I think a lot of people don't really know what you do. And but I think you have a really interesting career in that you started one thing and then you moved into raising and investing money. I'd like to maybe just educate the audience on what you do, and what part of that, when did you make the transition to do it yourself? And what part of that do you like the most? Is it investing or raising money? And then we'll get to Bitcoin, but I'd like to maybe take the first half hour, just talk about what you do and how you do
cool. Love it.
Cool. So what do you do, Mark?
Gary, that is such a great question. What do I do? So I am a self-described late in life venture capitalist. So, what does a venture capitalist do?
Yeah, exactly. What does that mean?
Yeah. So venture capitalist is someone who deploys capital. Now it could be your own capital. There are, angel investors and wealthy individuals who deploy their own capital. There could be, you could raise money from other people. So that's what we do. We actually raise money from other people to invest in the earliest stages of business formation. So venture capital, as far as I know, it traces all the way back to the 1400s, when the New World was being discovered, and I'm sure there's examples before this, but Queen Isabella, basically said, I'm going to take 20% of what you, Christopher Columbus, bring back. So the carried interest. So she took an interest in what he was going to bring back from the New World. And, she basically put at risk capital, right? She funded the ships. And back in those days, right, a lot of ships didn't come back. they sunk. And so, in some ways you could call it an adventure capital, but because it was really an adventure whether or not you were going to survive. But capital to help people build and grow businesses from good ideas. So I started, go way back when, as an allocator of capital to venture capitalists. So, you go all the way back. And it's not what I thought I was going to do, but I ended up working at my alma mater at Notre Dame. And we had a portfolio that was the endowment. So an endowment is capital that's given to the university. And there's so much misinformation about endowments right now. There's all the scandal about Harvard. No, why would you give money to them? Their endowment's $50 billion. Like, well, it just means you don't understand endowment. Endowment's not like a big cookie jar that you can go take the money out. When you give a gift to a university, that principle, that corpus, can never be touched. It's permanent capital. The growth on top of that can be spent to fund something that you care about. So let's say you want to fund a professorship or a scholarship or some other program or the maintenance for a building or whatever it is. There are expenses in running that business. And you want to make the place better. You want to bring a new business, or a new concept, a new program, a better professor, a better student. And you endow, which means in perpetuity, like literally forever, this program. So you never get to spend the principal. You can only spend the gains and the income above that. And so when everybody gets all up in arms about how big these endowments are, well, that's because the corpus is a lot of thousands and thousands of gifts that endow different programs that make that university better. So I worked at Notre Dame, and we had an endowment, and we were lucky. We had this visionary board member who had been part of the Boston venture capital scene. Now, what most people think of when they hear venture capital, they hear, oh, Silicon Valley, right? And maybe you hear about Austin, Texas, or Research Triangle Park, or New York, but most people think of Silicon Valley. Well, it didn't actually originate there. It actually originated, I said, way back in Portugal and Spain, and said probably even before that, in biblical times, there was probably stuff doing, people doing similar things, but it started really in Boston around a place called Route 128, which is outside of Boston. And there are a bunch of companies that got founded by people who wanted to invest their capital or other people's capital in this innovation around computers. So back in 1954, there really were no computers. I mean, the government had a few beginnings of computers, and people have been working on computing machines for centuries, but mainframe computers were this novel idea. And there was a company called Digital Equipment Corp, and they got $70,000, which in 1950, something was a decent amount of money. And they started this company, DEC. And then other companies, Unisys and Wang and Burroughs and a bunch of other companies got formed. And we had this explosion of value created around the ability of not just governments doing computing, but businesses doing computing. And then 14 years later, there's this innovation out in Silicon Valley around the microchip. And the world shifted, the center of the universe shifted out to Silicon Valley. And this young guy at the time, Don Valentine, invested in this little company that you probably never heard of called Intel. I'm just kidding around. And eventually went on to form Sequoia, which now everybody's heard of. But back then, no one had really heard of these guys. And there was this guy, Pitch Johnson. It's like the greatest name for a venture capitalist, Pitch Johnson. I mean, it's just awesome. And a bunch of other, Bill Draper, Senior, Tim's dad. And all these guys were putting capital at risk. And a lot of times it went to zero, right? Which is kind of the point, right? You're backing ideas that aren't guaranteed. This isn't growth capital where you're giving money to businesses to help them grow because they're already established. It's not a buyout where you're buying an established business.
Let's differentiate. So Warren Buffett is not a venture guy.
No, not at all.
Investor in a Goldman Sachs. It's a growth business. It's expanding. I call Warren Buffett actually a vulture, and I say that with respect, but he just waits for the moment to pounce. I can't remember what that's called. Pouncing.
Distressed investing. Yeah, a distressed investor.
Exactly.
And look, what Warren is maybe the greatest financial engineer in history. People think he's this, value investor, and that's a good story, a good narrative. But what he really is he created, with the help from, his dad was a very powerful politician, and he got some legislation passed. He's the only company of its kind that never pays taxes. Never pays taxes, not ever, and never will. It's amazing. And you can't get that structure anymore. So that's the first part of financial engineering. The second thing that he did that's mad genius, he converted the textile company, Berkshire, into an insurance company with Geico and other businesses. And insurance is a form of leverage with a negative cost to capital, meaning you get paid by the people who pay the premiums to use the money until you have to pay the claims. So instead of like borrowing money from the bank where you have to pay interest,
I never thought of that.
You're getting paid.
Fascinating.
Right?
Yeah.
It's a negative cost of capital lending. And so he leverages low volatility, high cash flow assets. So he bought Wells Fargo years ago and said, oh, that's such a genius value investment. Nothing to do with the value. It had to do with the fact that they were the first bank to go from mostly interest earnings to fees. More repeatable, more durable, more consistent, and they paid very stable dividends. So if you buy a portfolio of businesses, candy companies, very stable business, rug companies, Mohawk Carpets, right? Very stable business. People wear out their rugs. They got to get new ones. You buy these very stable businesses and you put them in a portfolio and they pay you dividends, or they buy back stock. That's another little trick he's good at.
Right.
And you lever that up. So you're basically got a levered S&P portfolio that never pays taxes. I mean, literally, my mind explodes with how genius it is.
Yeah.
But it's not what people think, and it's certainly not venture capital. He
Yeah,
buys mature
yes,
business.
yeah, that's what I wanted people to understand, like the difference, because we use a bunch of these buzzwords, and very few people really understand venture versus family office and angel investing. I mean, what you described, I just do myself, right? I invest my own money mostly. I might work with a guy like you. I mean, I probably would. You're going to see deals I never see, like you saw Liquid Death. I think that is like one, I have a water problem. I hate drinking water until I met Liquid Death. And people look at me and go, hey, you're just buying a marketing scheme. That water's no better than any other. I have drank every bottle of water on this planet. I hate them all. And when I drank that bottle of masseuse gave it to me, it sat in my house for a year. I was like, that's the dumbest name for a bottle of water I've ever seen. But I grabbed one day and it was ice cold. And I was like, wow, this is awesome. And then you told me you invested in that deal. That's the kind, like, let's talk about that deal, because that deal had no revenue, correct?
Yep.
When you saw it.
Absolutely. Yeah, absolutely. No revenue. It was an idea. And so that's most of true venture capital. And now let's bring it. There are even different stages of venture capital, right? There's late stage venture capital, which these companies have lots of revenue. It's almost like growth equity.
Give an example of a venture deal. Would that be a chain?
I mean, that would be a late stage deal. Would be a company like Databricks, right? Databricks is a competitor to Snowflake. They help companies manage their data. It's a mature company. They have lots of revenue, but they're still private. Now, what venture capital does is it invests in private businesses as opposed to public companies. And if you're raising money in the private markets, you have choices. You can get it from a venture capitalist. You can get it from a growth equity fund. You could borrow it, right, from a bank or a venture lending company. Or you could get bought out, right? Private companies sometimes get bought out by big buyout shops like Blackstone and KKR. And they're buying the whole company. A venture deal, you're buying a piece of the company to give the company money to grow. But there are lots of examples of later stage deals. They're less risky. In many cases, you're giving them money to put the last finishing touches on the team or the product before they go public. And companies like Fidelity and Wellington and all these big mutual fund complexes have made a living making these last round private investments. Now, you don't make 10 times your money or 20 times your money or 50 times your money or 100 times your money, but the risk of losing all your money is almost non-existent. So you're going to make maybe 2 times or sometimes maybe 3 times your money because you're getting the premium when a company goes from private, right, to public, where everybody can buy it. So you go back even further. There's late stage venture. There's mid stage venture. There's early stage venture. Well, what's early stage venture? Well, it's a startup company. Now, it's not a seed stage venture or a pre-seed. So think about pre-seed as Mark and Gary sit here and say, you know what is missing in the world? What's missing in the world is a really good drinkable bottle of water. Okay. And I would agree. Most bottles of water you take, they don't taste very good. I actually like Dasani because whatever they put in, I think it's cocaine. It tastes good to me. But let's say we just came up with that idea. And what if we then said, what's missing? And this is actually a true story. There was a guy who said, what if we create something where we put vitamins in it? It's called vitamin water. So that was an idea. And at the time, people said, well, that's a dumb idea. You just take your vitamins in pill form. I'm like, well, no, people like to drink. Well, then they put a bunch of sugar in it and coloring and just made it Coke without the name. But that business went from an idea to $1 billion market cap and got bought, and the rest is history. But all along the spectrum, from idea to yes, that might be to, I talked to a company this morning. They're in the music royalties business. They're helping writers actually get paid for all the streams that are happening on Spotify. And they actually have some revenues, right? They're early stage. They raised some money from some friends and family, and now they want a professional investor to come in and invest. So that's an early stage investment. So Liquid Death was
where do you participate? Like, at what stage? Is it early idea stage, or is it revenue?
Our sweet spot.
I've never understood the guys like Dan, and I like Dan Tapiro, but he will only do, hey, I need to invest $50 million. I need revenues of $50 million for a company. I'm like, wow, but you could do 20 million and get an exit, a $500 to $800 million deal in 3 or 4 years. To me, the return on early-ish stage, I would say stage A, raising $10-ish million or $5 million. Like, to me, those are the safest plays with some revenue, some traction, and a good management team that you can identify.
So what Dan does, and look, I love Dan Tapiro. We're buddies, go back a long way to our macro days. I officially call us the OMGs, right? The old macro guys.
Yeah.
And we all kind of saw the light in Bitcoin and digital assets because of macro. We thought it was the greatest macro trade, and we'll talk about that later. But a lot of people know the name Sequoia today. They know the name Kleiner Perkins. They know the name Accel Partners. They used to do just early stage investing. And then they did a little later stage investing. And then a company came along 20 years ago called Silver Lake Partners. And Silver Lake said, well, we want to go later. We want to buy established businesses, not doing debt financed buyouts, but really doing growth capital for these later stage deals. And that's Dan's trying to do that today in the digital space, where you've got early stage investors, what we do, what Pantera does, what Blockchain Capital does. We're looking for ideas, maybe not all the way down to pre-seed, 2 gals in a garage with a whiteboard. Maybe we want a little more substance, but we will do some pre-seed. But mostly we like seed and early stage, where the idea is starting to come together, teams together. You've got some potential customers, but it doesn't have to be an established business. Nothing wrong with that business, and all of it has to do with risk and reward. Right? The reward is lower, but the risk is lower. In early stage and seed stage, the risk is high. So back to Liquid Death. Liquid Death was something we did a small fund called the Innovation Fund. And that was all about a couple things. One, we put a bunch of Bitcoin in it because we thought Bitcoin was an innovation around money. And we didn't buy it to trade it. We bought it to hold it. And we bought it 5 years ago, and we're still holding it today and it's doing nicely. The rest of the fund was to invest in ideas. And we met Peter Pham through another deal that we were doing. And he said, hey, I'm starting this company, Liquid Death. I said, oh, okay, describe it. He said, it's cool water. Like, what do you mean? He says, well, everyone's gone to the club and they feel geeky walking around with water. So we're going to put this amazing label on the can, and we're call it Liquid Death, and you can feel cool. I'm like, bad genius. And yes, it's just marketing and it's just packaging, but I don't care. It's mad genius. I'm like, yeah, we're in. Now, we didn't put all our money in. We put a small amount of money along with a bunch of other people putting a small amount of money, because that's how you manage risk.
What type of wedge will you put in there? Like, what does that look like to the audience? Is it $1 million, 1% of your portfolio, or?
Oh, yeah, okay, yeah. So back then, they a few through each deal, we put in, I think we put in 100K. So it wasn't a lot of money. But it was at a tiny valuation, and maybe a couple $1 million valuation. But you say, well, what are you paying a couple $1 million for an idea? Well, it's because we thought the idea could grow, and it has. And usually you tell stories that have good endings, not all the time, but usually. And I think recently they did a financing at 7 or 800 million valuation. So it's been a great investment. Now, again, we won't make all the money in the world because we didn't put in a huge amount of money, but no one did in those earliest stages. And so that type of innovation fund is designed to do pre-seed stage, really early stuff. And we did another one called 2U Laundry, kind of a simple idea. Instead of a dry cleaner where you have to drop your stuff off and then go pick it up, it's drop your stuff off and we'll deliver it back to you neatly done and folded and pressed, and not just dry cleaning, but all your laundry.
Right.
And I went to school at Notre Dame, back on the wall there. And believe it or not, even in the 80s when I was there, guys, not the women, guys got their laundry done. And this was a holdover for when it was an all guys school. So women, unfortunately for them, in the new dorms for women, because it went co-ed in the 70s, they put washers and dryers. Totally sexist, totally ridiculous. But us guys, we had a white bag with a number on it, and we dropped it off, and our clothes came back in a nice little bundle in front of our door, neatly pressed. It was amazing. And that's what these guys do
now. Lawsuits for 30
years. Yeah, right. Well, now you can't. Now they had to do away with it. And they weren't trying to be bad people. They just were old school, good Catholics. And but the point was, these guys figured out that guys and gals now, they're busy, they're working hard, they don't have time to do laundry, they don't want to go to the coin op laundry, and some of the apartments don't have them. So drop your laundry off and we'll return it to you. Business has grown nicely, really, really interesting. So we've done a number of things, but our core business, what I do now, is this late in life venture capitalist. So I started as an allocator back in the 90s, and I allocated, because of this board member, we allocated early to Kleiner Perkins Caulfield Buyers when it was still called Kleiner Perkins Caulfield Buyers. I always feel sorry for Caulfield and Buyers because no one ever talks about them. They call it Kleiner Perkins, or even Kleiner. Even Perkins doesn't get a shout out. But those other three guys were just as important as Kleiner in the early days. And long story short, that turned out to be a really good investment. But the bigger one for us was this little company called Sequoia. Now, at the time, Sequoia almost ceased to exist. And it's not quite that dramatic, but what happened is Don Valentine, genius, God rest his soul, passed away a couple years ago, hired this guy, Michael Moritz. And Michael was a Wall Street Journal reporter who had never done a deal. And Don hired him. And the other partners were like, what the hell? Wow. We're the future of this firm. Why are you hiring this guy? And clearly Don saw something, and Michael's turned out to be one of the greatest venture capitalists ever. So whatever he saw, he was right. Part of it is, and I believe this, in fact, Tom Marsico, very famous asset manager in Denver, only hires journalism majors. And it's because he believes, and as Don Valentine maybe did, journalists ask better questions. And I will argue, and I say this all the time on Twitter, in life, everything in our world is about answers, right? We train our kids, spit back answers. Answers are everywhere. You ask people a question, you're listening to the answer. What's way more important is the questions. Questions and follow-up questions based on the information you get from the first question are the key to success, I think, in everything. If you're solving for great questions rather than having an answer with no question, or there's a lot of technology that it's a solution for a problem that doesn't exist. What's better is to find a problem that really is tough and sticky, like search. what the rest of the story is we invested in Sequoia because we trusted Don, and he invested a little money in this company called Google. And my aha moment in my life, where part of the reason I'm sitting here talking to you, was we invested in Sequoia and they invested in Google. And at the time, I remember our board like, what? That's a stupid name. And like, okay, now it's a verb, right? How many times have you used that verb in the last 5 days? A lot, right? But they're the number 21 search engine. Why do we need another search engine? We got Ask Jeeves, we got Web Crawler, we got Alta Vista. What they didn't understand, I didn't even understand at the time, they weren't doing search, right? Search is where someone asks a question and you go out to the internet and you search everywhere to find the answer. And they're like, oh my God, that's going to take so much time and we don't know where to look. And what if we miss something? They're like, no, we're going to take the questions, again, which are the most important thing, and we're going to find the information to answer the question, and we're going to assemble it into a web page, an index. And so today, right, there are 1.7 billion web pages. Google owns half of them-ish. And every time you type a question, it knows where to send you. Now, if you ask a new question that has never been asked before, they'll go find the data and create a new web page. But that innovation was so valuable that our little $500,000 investment turned into $200 million. Wow. And the light bulb is like going off. I'm like, okay, this is what it's all about. And so
that investment that Sequoia did, you were basically fund to fund, right? So
yeah. We were an allocator.
Yeah.
So we were the owner. Notre Dame owned the assets that had been gifted to us. Scott and I went out to California and we met with Sequoia and we gave them $5 million. They made the decision.
This is when you're working at Notre Dame. This isn't your fund yet.
Yeah. Back in 1993, 94.
I didn't get that. Okay.
In my earliest days. And I said, it's when I had the aha moment that investing in technology, particularly influential technology, particularly disruptive technology, was where all the great fortunes are made. In fact, if you look at my pinned tweet on Twitter, it says, the greatest wealth comes from investing in innovation. In order to do that, you have to invest in something that you believe in before the majority of people even understand it. And you'll be mocked and ridiculed for your non-consensus action.
Yeah.
But it's totally worth it.
Yeah. But if I could pivot though, Mark, so because what the piece that I think people don't get is that you were working for effectively a very large company, and you were seeing deals. Sequoia would come to you, show you a deal. That was your job. And then at some point in your life, after you did the Google thing, you were like, hey, can I do this on my own? Can I raise money? To me, the investment you made was in yourself. You learned from your career and you said, hey, I'm going to pivot now. I think I can do this. I've met every major player, private equity, venture guy. That's the way I see the story. Everybody walked in your office.
No, look, you're exactly right. But I'm slow, Gary. I'm not really quick. Which is why now I'm old.
You look like you're doing okay to me.
No, you're kind. But here's the thing. I was slow. So I worked at Notre Dame. I loved it. I was the number 2 guy. I was always going to be the number 2 guy. And a call came. There was this number 1 job here in North Carolina where I live now. And I told my wife, hey, there's a job in North Carolina. She said, take it. I said, don't you want to know what it is? She said, no, I just want to live in North Carolina. Tired of being cold up north. So we moved down here in North Carolina. And they had no venture at all. And so look, I had the greatest job in the world until the one I have now for 12 years. For 12 years, actually longer than 12 years, for 27 years. For 27 years, because it was 12 years within the endowment world and then 15 years in Morgan Creek capital management. And I'll get to Morgan Creek Digital in a minute. But for that 27 years, I got paid to go around the world and talk to the smartest people in the world and give them money to invest on our behalf, or our clients' behalf. And I talked to literally some of the smartest people on the planet. Ken Griffin, maybe the smartest person I've ever met. You know, Myron Scholes, Nobel laureate. I mean, so many, Julian Robertson became a friend and mentor. And again, God rest his soul. And I mean, I was so lucky. I mean, I was the luckiest guy ever. I mean, I got
You
to
had a
do,
platform.
and
You had a platform and you
I
performed.
had, and I was investing a meaningful amount of capital on behalf of other people. And because of that, then to your point, we would see deal flow. And starting in 2000, we started what I call a culture of co-investment, where we would invest in a fund and they would do 20 deals and we'd be meeting with them. And I'd be talking to you, I'd be, Gary, you know, what are you working on? And you'd be, oh my God, I am so excited about this, you know, water company. I go, oh, tell me more. Oh, well, it's this company. We're going to make a cool can. And I went in. And like, oh, well, we're going to do it. And, you know, Kleiner's going to do it. There's really not, I'm like, come on, give me 500K. And we would beg our way in to deals. And we, through this culture of co-investment, I started doing co-investing, which is not the same as direct investing, but you're analyzing deals instead of managers. And it's a little bit different. But what it also did, it helped me crystallize my thinking, which now I talk about all the time. People are sick of hearing it. There is a cycle in technology that's been going on since those days of Route 128 in the 50s, where there's an innovation, a major innovation every 14 years. And people say, well, why is it 14 years? I'm like, I don't really know, but it has to do with young people always invent the great stuff because they don't know what they don't know. And 14 years is half a generation. So maybe it's like every other generation, or maybe only part of a generation, or whatever it is. But in 54, this mainframe is created, 68, the microchip, 82, the personal computer, 96, the internet. That's when we did the Google thing. 2010, the mobile net, right after the release 3 years earlier of the iPhone. And we did investments in Facebook and Alibaba and all these e-commerce companies. And then 2024, which again is a few weeks away, is the beginning of the truth net. And what is that? Well, that's where blockchain technology displaces all these other operating systems. We've had an evolution of operating systems. And if you invested in each one of those waves of operating systems, you can make outsized returns. And if you look at the best investors in the world, right? The Yales, the Princetons, the Stanfords, the UNCs, the Dukes, the Notre Dames, what do? They have a huge overweight in venture capital, a huge overweight in early stage venture capital, a huge overweight in these technological innovations. And so the aha moment, again, for me, the first one in 94, 95, investing in Google. The second was this 2010 experience investing in companies like Facebook, and also in that interim market between private and public. So Google goes public. I'll never forget this. So there was a firm called Integral Capital. Roger McNamee, famous investor / guitarist out in Silicon Valley, also runs something called Elevation Partners with Bono that does music. And Integral Capital was one of the earliest crossover investors. They would draw capital, invest in public stocks, and then as they saw private deals, they would invest in those private deals in venture. And this, guy I knew worked there, and I'm out there talking to him, and Google had just gone public and had gone from $100 to 50, right? It'd fallen 50% because people were like, oh, they don't make any money and they don't know how to monetize, right? And we actually had a hedge fund, a value-based hedge fund that was like, this company's going to 25 easy, you got to be short it. And so I'm talking to this guy, Glenn Kacher, who worked for Roger. And he says, Mark, are you joking? Google's $1,000 company. I'm like, Glenn, shut up. It's $50. What are you talking about, $1,000 company? He says, you don't understand. They have changed the world in technology and they're going to dominate. And it's $1,000 company. Now it's more than $1,000 company today. And Glenn is a seer, right? He sees things that other people can't see because he's willing to imagine the unimaginable. And so that aha moment was the second aha moment where I said, okay, now I want to align with these seers, with these people who are in the flow. And so spent the next decade building really close relationships with all those types of early stage investors. And so basically how I got here is, I left North Carolina in 2004 and I set up Morgan Creek Capital Management. And what was that? We took the endowment model, right, what all the endowments were doing, and we tried to make it available to other investors. And we did that with varying levels of success for 15 years. And to go all the way. So 10 years ago, a good friend of mine from the hedge fund world, Dan Moorhead, who's now become a great investor in digital, invited me to come to California, and he said, "Hey, I'm shutting down my hedge fund." And we had helped seed his hedge fund 22 years ago when he spun out of Tiger, because we did that a bunch. And I said, "Dan, why would you give back $1 billion at 2 and 20?" And he said, "I'm going to spend the rest of my career in Bitcoin and blockchain." And look, in 2013, I was not running drugs on Silk Road. I was not a cryptography student. I had heard of Bitcoin, but I didn't really know what it was. But when he explained that blockchain technology, which we had heard about through other venture funds that had done some early investing, like August Capital and Excel Partners. So I was like, okay, I kind of understand that blockchain's this next evolution that's coming down the pike for operating system for computing. And I actually had my aha moment on that 4 years later in 2017, where it literally hit me that blockchains are just operating systems, just like iOS and Android or DOS and Windows. But Dan said, okay, I'm going to do this. And look, I wasn't smart enough to buy his Bitcoin fund because I didn't get it. But I did invest in his venture fund, and that venture fund's up, I don't know, 17 times or something. It's done really well because the infrastructure for this next wave of innovation that starts next year is going to be big. And so it took me a while. I mean, it actually took me 5 years. I told you I'm slow. It took me 5 years to finally get up the guts, the courage to say, you know what? I'm going to do this. And I have to give credit where credit is due. It was Pomp. I mean, Pomp, I met this young guy. Everybody knows Pomp now, but at the time he was relatively unknown. He's from North Carolina, and we met. And the way we met was through a co-investment we did, which was our first direct investment. Okay. So we had done co-investments in all the ride-sharing companies. Quaddy, before it became Didi, Uber, Grab, Ola, and this little company, Lyft, heard that we were on the cap table of Uber and said, hey, they asked a friend of mine out in California, do you think these guys could close really fast? We need 10 million more. This was the deal. This was the round before the Icon round. So the CFO of Lyft calls me up and says, hey, I work at Lyft. I'm like, yeah, I know Lyft. He says, would you consider? And I'm like, yes. He's like, can you close by Friday? I'm like, yes. And it was something we already had lots of experience in, but I wasn't going through another fund. This was a direct on the cap table, first direct investment. And we put together an SPV, and I was talking to Pomp and his partner, Jason, and we talked about a bunch of stuff, but we met 15, 20 minutes. And then I heard him on a podcast. Why podcasts are great. I heard him on Shaughnessy's, Patrick O'Shaughnessy's podcast. I'm like, interesting, smart guy. All right, I want to meet him again. So we had breakfast, turned into lunch, turned into dinner, turned into the next day. We didn't sleep together, but no, I'm just kidding around. But we hung out for the next 4 or 5 days, almost nonstop. And we decided we were going to build a business. And I wanted to do what I'd always done. Fund of funds, allocate other people's capital to the smart investors and co-invest. He said, nope, we're going to be a venture fund. Like, well, how are we going to do that? Like, who's going to give us money to go direct invest in venture capital? So we'll figure out a way. And I'm like, all right, fine. And so we launched Morgan Creek Digital.
He thought he could locate the deals better than the venture guys that were in the space that came from the analog, or what was?
No, I wouldn't even say it was that. I mean, maybe a little bit of that. I mean, the one thing I love about Pomp is he's a very confident person, not arrogant, but confident. And, you know, I like that. And there's a fine line. But it wasn't that he was necessarily saying we were going to be, he's like, look, there's no competition. There's Pantera, there's blockchain capital.
Yeah.
There was no A16Z crypto. There was no paradigm. There just wasn't anybody out there. And now the funny part of the story, he goes up and first meeting, we send him up to do a sales call because you got to raise the money. And you asked me what I like to do, invest or raise. I like to invest. Raising money is hard. I mean, it's super hard.
It is.
I actually enjoy it, but it's hard. So he goes up and we just lucked out. Like my life, series of happy accidents. Luck, whatever. And luck is where preparation meets opportunity. I got that from Socrates, but I've been just super lucky and very blessed. And we just got lucky. And we met this amazing CIO, Catherine Molnar. And 10 minutes into the pitch, she's like, I'm in personally. And I will find a way to get my board in. And Pomp calls me up. He said, we're going to raise $1 billion. It's going to be amazing. We didn't raise $1 billion. We raised $40 million. And Catherine and her partner, Andy, were half of it. And the reason we didn't raise $1 billion, the next 35 meetings, over, including Utimco, literally laughed him out of the office, said, just go away. This is stupid. And it was tough. It was tough to raise money, but we raised 40 million bucks. We put it to work, 30 companies. That first fund's done quite nicely. And that led us to the second fund in 2020, and then a third fund in 2022, and we're raising our fourth fund today. So, and one little caveat, you know, Pomp and Jason downshifted to venture partner, and they're working on their media stuff. And I've got 2 new general partners for funds 3 and fund 4 that run the show now. But here's the thing. And you and I talked a little bit about this when we got together here in Chapel Hill. I'm having more fun today than I've ever had. And that's not a criticism of any part of my career. I loved working for the universities, what I call my chapter 1. I loved building Morgan Creek Capital Management, you know, building an asset management company. I loved it. I loved our clients. I loved the process. I loved hanging out with the really smart people. I loved the co-investing. But today, in what I call my chapter 3, and I always say chapter 4, I'll teach. But in chapter 3, I just love hanging out with young, energetic, passionate people who are building on a platform. As Newton said, I'm not that smart. I just stand on the shoulders of giants. Now, he was pretty smart, but he said, look, if you think about computing, when the first computers came out, they were not very great. They were fine. But then the next generation stood on their shoulders and they were a little better, microcomputers. And then personal computers were a little better. Then client server technology, and then networking, and then the internet. That was pretty good. But the mobile net was even bigger, right? Web 1 created $2 trillion of value. Microsoft and Cisco and all that. Hey, Web 2 created $5 trillion of value. That's better because we were standing on the shoulders of giants. Web 3, or the spatial web, right? This is just starting next year. I think creates 10, 15, 20 trillion because it's exponential growth. It's not linear growth. And we're standing on the shoulders of these giants. And so the technology around Web3, and more importantly, the talent. And you and I have talked about this as well, Gary. If you're the smartest person in the room, find another room, right? You know, you want to surround yourself with people that are really, really smart.
Another room.
I love being the dumbest person on every Zoom that I do. I mean, it's just awesome. And
now,
these
you
people
don't
are
really,
so
you don't really
talented.
believe that, do you?
Oh no, I do. Look, I'm actually not, you know, I was the last person admitted to Notre Dame. I mean, my scores were not good. I have some talents, but raw intellectual horsepower is not my thing. Was my because I at the time I was like, what do I have in common with this person? But I got to meet with Coach K, And look, I'm a Carolina guy. I bleed Carolina blue. I'm a Notre Dame guy. I bleed, dark blue. But I respect Duke, and I respect Coach K as maybe the greatest basketball coach in all time. And that's in all reverence to Dean Smith. But K has the numbers. And I got to meet with him once. And about halfway through the meeting, he says, we had the same job. And I'm like, okay, coach, humor me. I don't see it. What do I have in common with literally like the greatest basketball coach of all time? He said, well, think about it. We both identify talent. We recruit that talent. We put that talent on a team. We train them. We draw up a game plan. We put them on the floor and we sit down. He says, I never take a shot. And at the time I was an allocator. He says, you never actually make a direct investment. Like, oh my God, I had the same job as Coach K. And the key was identifying talent, recruiting talent, assembling a team and a game plan. I actually think I'm decent at that. I've spent a lot of time with people. I've done thousands and thousands and thousands of meetings with the very smartest people. Yeah, I think make great investors, great business builders. And I learned a lot from my mentors, right? I mean, I was lucky. I get to spend a huge amount of time with Julian Robertson. Maybe the greatest identifier and trainer of talent the investment world's ever seen, right? The people that worked for him today control about 10% of the long short assets in the world. It's a pretty big thing. One guy, I mean, and his thing on identifying talent was there's certain things that you're looking for. One is competitiveness. He said, I don't care in what, golf, tennis, tiddlywinks, I don't care. I want the most competitive people on the planet. And that is axiomatically true, right? People, and I always ask the question, do you like to win or do you hate to lose? And there's a difference, and it's subtle, but both are important and they're different types. But that's one. The other is integrity. Like you're playing golf with someone and they're always improving their lie. Doesn't mean they're a bad person per se, but if they cheat at golf, they'll cheat on you, right? Because when it comes down to that time where they got to mark an asset in their favor or yours, they're going with them every time.
For sure.
Because the rules don't matter to them. They're flexible. So integrity. I mean, that was something that I have I have a more colorful word, but the no jerk rule. And I've only violated it twice in my career, and I lost money both times. It was just dumb. And I was like, no, this person's so smart. I'm like, but they're such a jerk. But I violated the rule, and it cost me money both times. Another is the ability to be resilient. One of the things that, and I rail against this, and I don't want to go off into this tangent, but one of the things that's really important to me is early childhood education. I think we do it completely wrong.
Yep.
To create knowledge. It was career and to basically beat out creativity and innovation. And I hate that. But the thing that we discourage is failure. I use a simple example. I live affectionately in the People's Republic of Chapel Hill, where they don't keep score in soccer. Like, wow. Why not? Well, someone might lose. Like, that's why we play the game. It's winning and losing. I mean, losing teaches you more than winning. In fact, on my desk right over there, I have a quote from Seneca, right? 2,000-year-old wisdom. Failure changes for the better, success for the worst. You don't get better when you win. Like Bill Duhamel, great hedge fund manager, has this great line. With every investment, we get richer or wiser, never both. Because when you win, you don't really analyze. You're like, oh, look how great I am. Look how smart I am. When you lose, dang, what did I do wrong? How can I get better? How do I improve? And so that ability to be resilient and to fail, again, before it was uncool to quote Will Smith, he has this great line, fail fast and fail forward. Right? Don't be afraid of failure. Don't be afraid of losing. and here's one of my things I do this on Twitter all the time, that winners lose more than losers. People are like, what do you mean? Like, well, losers are so paralyzed about losing, they never try anything. So they never lose, but they never win.
Yeah.
Winners don't care about losing, right? That's again, another Coach K quote, right? What separates the average player from the great? Average player always focuses on last play. How many times do you see someone miss a shot, commit a stupid foul? Because they're thinking about the last play. Great player, focus on the next play. Michael Jordan says, I missed 19,648 shots. I don't even remember taking them. I literally don't remember taking them. He'd miss a shot. Okay, so what? Go back, play good defense, steal the ball, make a layup. Because he's focused on the next play. And so that resilience and that ability to focus, and you know this too, right? Because you've done this in your career. I would say, I know in 5 minutes, I'll never work with somebody. Now, it might take me 5 years sometimes to actually warm up to them and get to know them well enough that I trust them. Sometimes I know in 10 seconds, but I know in 5 minutes if I'll never work with somebody. And that's the gift I was given by being entrusted with these assets of other people for all these years and being in an allocator role. And I think now it's made me a better investor on the direct side, because at the end, it's all about people. You're backing people.
Yeah.
You're backing ideas too, but a great person can take a mediocre idea and make it great. A bad person can mess up the best idea in the world.
Yeah, I was going to ask you, when you look at investment, and then we can move to Bitcoin if you got the time. But is it the idea or the team that's more important? You have to pick one. Great idea, asshole team. A narcissistic sociopath.
Nope, I'll always go with the team. I'll always go with the team. And it doesn't mean, I'll always go with the team.
Yeah. On that, do you think it's better to be early or a little later to the table? Like in this,
again, that's a great question. That's a fantastic question. So for me, I don't mind the losses. Just doesn't bother me. In fact,
well, when you say losses, you mean your paper losses.
No, I mean real losses. Like in venture, right? In venture, you have a bell-shaped curve, and you have a bunch of things in the middle that do meh. They do fine. They don't do as well as you thought or as badly as they could have done, but they do fine. Maybe you get your bait back. Maybe you make 1.5 or 2 times. And then you've got this left tail of the things that literally go to zero. They just go away. On the right tail, you got the 20 baggers, the 50 baggers, the 100 baggers, that change the world. You don't get those very often. And they are the fund makers. The losses are real. And here's the thing. In seed stage investing, early stage investing, if you don't have zeros, you're not doing it right. If you're doing late stage investing, you better not have very many zeros, because you're not going to have the big upside. And you can do structuring because you're in preferred security classes where maybe you protect your bait, but you don't want to have a lot of zeros. When you're doing buyouts, you better not have zeros. So depending on where you are in the life cycle of the business and the capital stack, it depends. But for me personally, I like the early stage investing. I like the pursuit of the really big win, the market moving, game changing, industry making opportunity. And I'm willing to have some of them not work. So, but that's me. In terms of overall portfolio management, which is what I did for a living for most of my life, I would never put all my money in venture, but I have more than most. And if I think about the great investors, right? Yale has 23%. And Jeremy Grantham's private foundation, which is a little better than Yale, has 40%. And there's this foundation in Pennsylvania that has like 85% private and just a little bit in cash to pay the bills. So those are extremes. The average person maybe puts 5 or 8 or 10% in a diversified portfolio. But I now do venture for my livelihood. And but I still don't do everything in the earliest seed stage. I'll do some, mid stage. I don't do very much late stage because that's not the right risk reward profile for our clients. But I like the business formation process around an idea where you're partnered with just really great founders.
Yeah. Yeah. And not to put you on the spot, but I showed you the Node 40 deal that I'm involved in. It's an early stage, right? It's $1.5 million or $1.25 million revenue. It's got a team. What didn't you like about that deal? Because you didn't jump on, maybe it wasn't the right timing, but when a guy like you.
Well, that's a great question. So it's not that we didn't like the deal. We actually liked the team. We liked the space, right? I mean, you identified the space very early, that there's this, massive disconnect between the people who own digital assets and actually understand the tax implications of those assets. For us, the challenge was timing, and not to go too far down this, but 2022, as you and everyone else listening to this knows, was what's the technical term? Shitty year for our industry, right? The digital asset industry
washing out the weak players, man, and the criminals. It needs to happen.
Well, exactly. But we took body blow after body blow from. Sure. It started on my birthday, right? May 9th, 2022. Luna came to Terra, which I always thought was ironic. And, bad people doing bad stuff. That crushed Three Arrows Capital a few weeks later, which then turned around and led to people like Celsius having to declare bankruptcy. And look, whether there were bad people doing bad things at Celsius remains to be seen. But one thing they were doing, as well as Voyager, is having a token that's captive, that you're leveraging. That's just a bad business model to me. BlockFi didn't do that. Others didn't do that, but that's a bad business model. So then you have this series of events. Then the granddaddy, as I call it, Hurricane Sam, bad person doing bad things. The problem with it, not a crypto problem, not a blockchain problem, a bad person problem. There's a bad person doing age-old bad things, stealing people's money. It happened in the S&L crisis. It happened in the global financial crisis. It happened in FTX. But what the government and others now want to frame that as, oh, that's a crypto problem. Only criminals use crypto. I'm like, no. He was a criminal.
Yeah.
Stealing money, giving it to political candidates to curry favor and try to get power. Again, story as old as time, not the first guy to do it.
Won't be the last.
And won't be the last, sadly. But, and look, I wear it a little bit as a badge of honor, but not because we're brilliant, just because we passed on FTX 3 times and people say, oh, well, why are you saying that? Like, look, I never met the guy because the numbers were so wrong. I never even wanted to meet it because the first time they showed it to us, an $8 billion valuation.
It's ridiculous, man.
On no revenue. I'm like, that doesn't make sense. Who would fund that? And then it went to 16. And then the last round with some really famous investors was 32 billion. And I think they had 40 million in revenues. I'm like, there's no way that works. So we never even went the next stage to actually meet with them. So I can't say, oh, I knew he was a fraud. Like, I can claim that back in the Madoff days, we actually had a client that had a lot of money with Madoff. And we said, take it out. And they're like, why? So, because they won't meet with us. I'm like, well, why does that matter? They're amazing. I'm like, well, but if they won't meet with us, there's something wrong.
Right.
Again, I didn't know how bad it was. Like, I didn't know that he hadn't made a trade in 13 years. I didn't know that his brother-in-law was transferring the money into his personal account. One thing I did know was he claimed to be doing index arbitrage, right? Index arbitrage is where 500 stocks in the index and you buy the index and go short the components, or you go long the components and short the index. Pretty simple strategy. Lots of people do it. But to do that on the amount of money that he claimed to have, he would have had to be the top client or top 3 client of a whole bunch of Wall Street firms.
I know.
And we would always ask, how
Yeah.
much do you trade with Madoff? And like, we don't trade with him.
Yeah.
Ever. Like, that's not possible.
Right.
I mean, that's literally not possible. So the funny part of the story, though, is, and I remember it like it was yesterday. It was November, I think it was November 8th. And we're having the family office meeting with this family. And the wife, as we walk in, and this was 2008, right, when everything was going down, says, "You are not allowed to talk about Bernie today. He's the only person making money. Everything you've recommended this year is losing money. All of our other managers are losing money." The next day was the day that his son turned him in, and everything went to zero. But it's crazy in the sense that people will believe bad people if they tell them a good story. And that's what Sam was doing. So my point there is, what was the original
question? Was on
Note 40. So
like
back to Note 40. So because of that series of events, in May, we were raising our 3rd fund, and we had closed on 75, and we had indications of interest for about 250. 37 people. We had one that told us they were in for 40 to 80 in May. By middle of summer, they were like 20 to 40. And by November, 0. And of those 37 people, only 2 closed. So we ended up with 125. And so our fund 3 ran out of money because we thought we were going to have more. And then we started to raise fund 4, which we hadn't closed when we were talking to y'all. We just closed a couple of weeks ago, first close. Again, much lower than we thought, because everybody's like, well, talk to me next year. I've already used up my bait or my capacity for this year. So it's not that the business doesn't fit the criteria we look for, right? We like the business, we like the idea. The team, solid, checks out. We like you, we like the partnership. So that it was more us just not having the capacity to do that round because we were in between funds. Now that we have a fund in 2024, we'll be back in the market and ready to work.
Yeah, I think the point that I was trying to bring up to the entrepreneurs out there, just because someone like Mark and I know each other, not exceptionally well, but I think well enough to do business. And he did not know I was going to ask this question, but it's a really good thing for an entrepreneur to know. Just because a guy with money and does this for a profession, he wants to see deals direct. Just because he doesn't say no or doesn't respond doesn't mean that it's about the company or about you. You need to go back. I was going to take this opportunity to go, hey, Mark, what did we do wrong? And if we did something wrong, it's awesome instruction for me. And I'm happy for 1,000 people to see it because, like, big deal. Okay, I made a mistake. I screwed up the meeting.
No, it's not. No, and again, I enjoy the conversation and appreciate the question. So it's, to your point, when a VC or when an investor either doesn't respond or delays, it doesn't necessarily mean no. And part of the problem is, you got 4 quadrants, right? Everything's 4 quadrants. So in this dance, there are 2 answers that are really valuable. Another answer that's fine, and one answer that kind of stinks. So a quick yes, awesome, very valuable. We all love it. Okay. A slow yes, it's good. I'd rather have a fast yes, but a slow yes is perfectly good. A fast no, hate it, but valuable.
Yeah.
Right? It's actually valuable because you don't waste time.
Yeah.
The worst is the slow no. The worst, because it's kind of a waste of everybody's time, right? If you're going to say no, say no. But part of the challenge is you don't necessarily know that you've made the decision. So sometimes it's sequence of events. It can be fundraising. Look, this is the worst fundraising environment I've seen in 35 years. Full stop. Full stop. And
It's so hilarious because, and that really segues really well because you talked about how, what a bitch last year was. Last year should have taken Bitcoin to $700. Okay. And it didn't. And I tell you what, man, I have been doing everything I possibly can to get access to cash because this is the time you want to be here.
oh my gosh, yeah.
I see how hard it is to raise money. I'm like, hey, this is one of the best businesses I've ever seen. So many of you guys have gotten clocked. You're dealing with problems. And when guys that raise money like you do, like your first job is, okay, plug all the holes in any of the ships that we invested in. Yep. Don't give a fuck about the next submarine that's going to come along that's going to make me $1 trillion. I have to protect the assets that are there right now. So everybody's into firefighting, fixing things. And that's why it's so difficult to get meetings because everyone bet on too much shit in 20 and 21. You didn't do this on the FTX thing because you're like,
we're not guiltless.
We probably did some.
We definitely participate. Look, the great line, Keith Raboy in kind of October, November 21, he tweeted out, yes, we've all lost our minds, but you go first. You skip that hot deal because you know the valuation is too high. And by the way, I'll take your capacity. And so we all did stuff that we regret. 100%. I mean, we're not guiltless. But your insight is really important, Gary, that all of us in this business are in triage mode, right? We're trying to save the things that are savable. Now, a really valuable skill, hard, but valuable, is the ability to put certain things out of their misery because they're not savable.
Yes, sir.
And that's hard because you're dealing with human beings and you're dealing with livelihoods and you're dealing with kids' tuition and food on the table. But at the end of the day, again, that if they're not going to be successful because the world has shifted or they just ran out of capital, it's better to not waste your time trying to triage something that's not savable and go on to save. And it's not it's a good analogy, but it's not pleasant to think about. But it's really like MASH, like a MASH unit in a war zone. You got a lot of injured people. You got to take care of the ones that are savable.
Yeah.
But they should all be savable. Well, there's only so many docs. There's more. I mean, it's a horrible thing to think about, and it's too extreme. But if a more pleasant way is there's this guy, William Deresiewicz, and he writes this amazing thing. He delivered a address to the pleb class at Army a number of years ago, and it talks about solitude and leadership and why you think they're antithetical, but they're absolutely important. And one of his points is that we've become excellent sheep. Like our process now is to have so many things on our applications for college and all this stuff. And he said, the average applicant to Yale has 12 extracurricular activities. And I actually asked a group of freshmen, what does that mean? And this one young woman said,
12 girlfriends or 12 extracurricular activities?
Extracurricular activities, right? Not girlfriends. But she said it best. She said, that's like dividing your soul into 12 parts.
Yep.
It doesn't work, right? You can't be good at 12 things. You can't. It's impossible. And so you can't take care of 12 bad companies. And so, or damaged companies. And so you have to choose amongst your children, which is really, really hard. So that's part of it. The other part of it is the challenge, and it's the hardest thing to do in our business. When it's easy to deploy capital, easy to raise capital, you should actually raise less and deploy less because the prices will be too high. The ideas will be too plentiful and many of them won't be very good. And a lot of bad stuff happens. And that's why those vintage years around the peaks of cycles are not very good. And you can go back to 2000, you can go back to in the 82, 86, right before the 87 crash. There are periods where bad stuff was getting done. Times like now, where it's so hard to raise money, this is the time you want to actually invest. And for for allocators, this is when you should be accelerating and putting more capital into the hands of venture capitalists and direct investments into companies, because the ones that survive are going to be the best companies. And I use a simple example. In the '01 recession, right after 9/11, the world's down and struggling and everybody's unhappy and stock market's down. And actually it went down even more in 22. And we got approached by this venture group, and they said, "Hey, we got this great idea. This entrepreneur wants to start. He wants to do a startup airline." And I'm like, "Dude, no one's ever going to fly again." No, I mean, that's a dumb idea. He says, "No, think about it." And this guy came in, and it was JetBlue. And this entrepreneur, he's one of the best I've ever met, right? And he went on to do it again with Azul in Brazil, and now he's doing it with Breeze again in the US. He's a genius. But what he says, I can buy the gates at 10 cents on the dollar. And I got a way better tech system than Sabre. So I'm going to save a bunch of money there. And I'm going to buy all new planes because no one wants to take their order. So I'm going to get all these new planes for super cheap. And I'm going to have a great airline. Sure enough, we actually made 10 times our money. The other one that I love to tell was in the '94 recession. Remember when the Fed raised rates unexpectedly? There was this guy, and he wasn't young, but he was young-ish, late 30s, young 40s. And
Like me and you.
he said, "Hey," he got laid off from Bell Labs. And he said, "Hey, can I take my project with me?" And they're like, "Yeah, whatever. We don't even know what dense wave multiplexing is. Yeah, be gone. Just get out of here." And he took it all over Sand Hill Road, and no one would back him because he had a simple idea that fiber optic cable carries X data. I'm going to shine light through a prism, divide into 8 colors, and I'll increase the capacity 8 times. People said, "That'll never work. That's stupid." Well, the only person he could convince, I love this story, was his retired 3rd grade teacher in Philadelphia. She gave him her life savings, which was probably not a smart decision,
No.
$300K. It turned out it was okay. An idea. It was called Sienna. And that $300K turned into $300 million. And I love that part. And that's venture capital. She trusted him. She thought he was smart. She didn't understand dense wave multiplexing, but dense wave multiplexing changed the world. And now you don't do 8 colors, you do 1,024 colors. And it increased the capacity of fiber optic networks. So you and I can talk in HD in real time. And so, or like the guy at MIT who founded Akamai. It's an amazing story, right? It's like 9 lines of code or 11 lines of code. It's not very much code, but everything that happens on the internet is better because of this company Akamai, and it's become a multi-billion-dollar company. But it was started at a time that was really difficult. Or Splunk, right? It was founded after the crash. So companies that are born in fire, usually they know how to budget. And I'll leave you one last story on this point. So I have a buddy, again, from that other school down the road. We always call it University of New Jersey at Durham, which is not generous, but Duke. And he's a venture capitalist, and he always raised small funds. And everyone else is raising these big funds. He said, "It doesn't work." I said, "Why?" He says, "It's like a family. When you're a young family, you don't have any money, and you and your wife want to go out to dinner. What do? You park the kids with grandma and grandpa. You save up for a month. You go out. You split an appetizer. You split an entree. You each have dessert. You have 7 cups of coffee. You stay there for 4 hours, and it is a glorious experience. When you get wealthier, right? You say, 'Hey, let's go out to dinner.' You drive to McDonald's because you can. And it's not a good experience. There's no planning. And it says, when you have a lot of money, so the companies got formed in 21, they were buying Super Bowl ads. They were hiring too many engineers. They were doing the things that make you a less good company versus having to bootstrap and having to actually generate revenues and actually having to win clients and not just have promise and a nice looking PowerPoint. So there's an inverse relationship between how hard it is and how good it is in investing. And most people don't like hard, right? So we're coming up on New Year's, right? And everybody's gonna say, "I'm gonna get in shape this year. I'm gonna eat right." And you and I talked about this, although we did have a couple of tequilas while we were doing it. But tequila is not bad for you. But we talked about this, that you have to commit to, right, actually eat right and stay in shape and and look, I'm a huge believer in this. Health is wealth, right? Without health, nothing else matters. Absolutely nothing else. And so, no matter how smart you are, no matter how talented you are, if something bad happens in your health, it's over. And some of that's random, but a lot of it can be prevented. And I think the same thing's true with businesses. The health of the business, right, needs to be monitored. And if you give it, constant sugar injections and steroid injections, bad things are going to happen. I lost your audio.
Yeah, thank you for that. I think that's a lot of cool, help for entrepreneurs, just to understand how a guy like you thinks. Let's talk about not so much the price of Bitcoin, Mark, but let's take you and your family, not the fund, but you as a experienced investor. You're running your own family's money. What do you think a guy in now let's just clarify some things. You and I are nearly the same age. I'm assuming your kids and my kids are going to be fine. My house is not leveraged. Okay, I have things I don't have credit card debt. Okay.
Right.
So I'm not going to propose that anybody buy Bitcoin if you have credit card debt. Go pay the credit cards off and then cut them into slices and look at every subscription you have and cut those because they're not bringing you any value. I'd rather buy a millionth of a Bitcoin. I'd rather buy $9 worth of Bitcoin every day than drink a Starbucks coffee. Okay, yep. The Starbucks coffee is not going to bring. Think about that Starbucks coffee costing me in 5 years $50 a day.
Yep.
I am not paying $50 a day. I'm not buying a new Range Rover that's going to end up costing me, 8 Bitcoin. Fuck that, man.
Oh my gosh, absolutely.
I got a great 2016 Range Rover right now. I don't need a 23 with the HUD. And I just look at everything as like, oh my God, that's going to be so expensive tomorrow. So what's the right allocation for a guy like you and me?
So again, fantastic question. And I start with an allocation kind of philosophy that says, I still think of myself as a young guy, even though I'm not young. I just turned 60, and but I plan on being around a while. And part of the reason, I have a unique family. So I have a 34-year-old, a 32-year-old, and a 12-year-old. Everyone else says, "Oh, when did you get the new wife?" I'm like, "Nope, same wife." Like, how's that possible? I'm like, it just is.
Good for you. I'll tell you how it's possible.
Yeah, and exactly. And it's awesome. And it's the greatest thing ever. It's the greatest blessing in my life.
Do you think you're a better dad today than you were?
Oh, it's not close. And it's not that I was a bad.
Yeah.
It's just I had no knowledge. I had no knowledge. There's no licensing. There's no testing. There's no book. I mean, there are books, but you go to the hospital and they give you a child and you're supposed to raise it. And so we actually know stuff this time. And so we're much better parents. Now, if you asked our 12-year-old, he might not agree with that, but he has no context. But
he doesn't have a vote either. He gets a vote.
He doesn't have. Actually, he's pretty persuasive. He's a smart kid. I think that goes from having older parents too. My favorite though was when he was 4. My wife and I are both dutiful firstborns, and perhaps we're different from one another. That's why opposites attract. He comes up one day and says, "Your words are bumping into each other." Yes, they are. Okay.
Wow, that's a good way to put it, man. That's
so great. So great. Your words are bumping into each other.
Bumping into each other.
So I look at it a little bit differently in that I think the bulk of my wealth should be in equity. And by equity, I mean ownership of assets. Okay. So the equity of businesses, the equity could be public equity, could be private equity, could be real estate, but the equity part, not the debt. In fact, for me, if you're under 65, and particularly for your retirement assets, I actually think it should be against the law, literally against the law, to have bonds in a 401k or 403b. Like, it should be against the law. It should have to be all equity because that's long duration assets. So that I start with an equity bias. I start with a value bias, like you. I mean, I drive a I like it, but I drive a little Kia, and I did it because I did the math, right? I'm in my car 3% of the time. It sits idle 97% of the time and depreciates. So I'm not gonna spend a lot of money on it. But I'm a deep value guy. And as you know, Seth Klarman at Balpo said, you're either genetically a value person or you're not. And it's not good or bad. You know, sometimes it might be a curse, but I'm genetically a value guy. And guy means guy or gal. But so from first principles, I don't have fixed income. My fixed income is my future income and earnings. So I have lots of equity. I have lots of private equity. I have lots of venture capital. Now, Bitcoin comes along, and I have the aha moment that Bitcoin is the anti-fiat, right? What does that mean? Fiat, which I've lived my whole life. We all have lived our whole life in a fiat world. And a fiat world is a currency, and this since 1913 in the United States and longer in the UK and longer in, you know, the first central bank was created by the Rothschild family in 1609 in the Netherlands. And since that time, Western banks have been devaluing their currency to steal the wealth from the masses and give it to the people at the top. Full stop. That's what it's all about. That's what inflation is. It's a stealth wealth tax that makes the rich richer and the poor poorer. So how do you defend yourself? Well, in the old world, pre-Bitcoin, you couldn't. You could be an owner of things, so you could own equity, and you could actually borrow, like leverage your house or leverage your stocks, and you could win. And so you could earn more than the government was taking away. But the problem is half the people, they don't own stocks. They don't own their house, right? They're renting. They're on a fixed income of sorts. They make minimum wage or some wage that doesn't grow very much. So they're being stolen from. And that's why from 1913 to today, we now have the highest wealth and income inequality in the history of the country. It was actually not bad before that. But once the Fed was created, it gave that, again, remember the Fed is neither federal nor has any reserves. It gave that banking entity the chance to control the price of money and steal. So Bitcoin comes along, and the aha moment is Bitcoin is an anti-fiat hedge. What does that mean? One Bitcoin is one Bitcoin. Will always be one Bitcoin. It's a permanent immutable ledger backed up by the most powerful computing network in the world. But we don't price Bitcoin in Bitcoin. We price Bitcoin in dollars or euros or yen or pesos or bolivar. So let's do the easiest example. In Venezuela, right? If you live there, they stole all your wealth because the currency is down 99.999%. Maduro and company stole everybody's wealth. Same things happen in Argentina over and over and over again, okay? Through devaluation of the currency. Had you taken those bolivars and put it in Bitcoin, the price of Bitcoin and bolivars only goes up because the bolivars are getting less good. It's kind of like this nonsense about inflation. We say, oh, we have inflation. No, we don't have inflation. We have currency devaluation. In 2020, the government in the US printed $10 trillion out of thin air, literally out of thin air, $10 trillion. They listened to Stephanie Kelton, and she said, print as much as you want. It doesn't matter. It took us 244 years to print the first 10 trillion. 244 years. And then we did 10 trillion in 18 months. So what should have happened? Well, the price of the money should have fallen in half. So what should have happened to the value of your house? It should have gone up. Because we don't price houses in houses, we price houses in dollars.
Right.
What should have happened to stocks? They should have gone up. What should have happened to gold? It should have gone up. Wait, why didn't gold go up? Well, gold's being spoofed by the big banks to keep it down because they're short it and they make lots of money doing that. But the bottom line, Bitcoin doubled. Just what it should have done. Because we don't price Bitcoin in Bitcoin. In the US, we price it in dollars. So I look at it, and I've said forever, right, since I first got exposed to this way back when, that you got to have it, zero is the wrong number. So you got to get off zero. Okay. How do you get off zero? 1%, then 2%, then 3%, 4 or 5%. 4 or 5% in Bitcoin, okay, I think can protect most people from the ravages of inflation relative to the rest of their wealth. Now, more is better. And if you're younger, certainly more is better. And if you look at the statistics, the average boomer, only 3% even own any, and it's not a very high percentage. 24% of millennials own it. And in some cases, it's a really big percentage. And that's fine because they're protecting themselves against the ravages of inflation. Because the only other way to protect yourself is just spend money. So you get the money and you spend it before it goes down.
Right.
And that is okay, kind of, if you're accumulating appreciating assets. Like if you're buying expensive cars,
Netflix and coffees. See, that's the problem. Those dollars aren't going to investments. They're going to things that just suck up energy.
Yeah, coffee.
So as a professional, though, as a professional trader, you're advising yourself, like clean sheet. Your job as a consultant to the Yusko family. What do you think the proper allocation based on what you know, and that your family is going to be taken care of, even if Bitcoin goes to zero? Like you and I said, okay, it could all go to zero. Okay, I'm still okay.
Yeah. I actually don't think that could happen, but
I don't
that,
think
to that point, that's how you manage. That's how you manage risk, is by position sizing.
Yeah.
So if you put 1% in Bitcoin over the last 10 years, okay, so the first 5 years don't really count.
I agree.
It wasn't liquid enough. It was a science experiment. It could have died. So we'll take those, but the last 10 years count. They're big enough that you could buy a lot. In that 10-year period, if you put 1%, 0.5% from stocks, 0.5% from bonds, your portfolio would have compounded 200 basis points higher. So it made 12 instead of 10. But more importantly, your overall risk actually went down. So your Sharpe ratio, your return per unit of risk, went up. Well, how is that possible? But Bitcoin's volatile. It is, but it's uncorrelated to the other assets. It's 0.0 correlated to bonds and 0.15 correlated to stocks. So when you do Markowitz theory, right, which is capital asset pricing model, when you take the riskiest asset in the world, cash, well, wait a minute, I thought that was the safest asset. No, it's the riskiest, because every day you own it, they're stealing your wealth through inflation. So if you add bonds, the risk of your portfolio actually goes down. Even though the volatility goes up, the risk goes down because your return per unit of risk goes up. If you add stocks, the risk goes down. Add hedge funds, risk goes down. Add venture capital, risk goes down. Add private equity, risk goes down. When you add Bitcoin, the risk actually goes down dramatically. And so 1% is the base layer, right? You got to have one.
Yeah.
I will argue 2 or 3 is better. And I can even argue that even with the risk, which again, I think is 0, but some would say it's non-zero, that something could happen that would make this technology go away, which, if you understand how the technology works, actually can't happen, right? But and they say, well, what if electricity didn't work anymore? You're not going to worry about your Bitcoin.
Credit cards aren't good either. Wire transfers.
Well, nothing works. Nothing works. I mean, you're not going to have food. I mean,
Venmo doesn't work. Zelle doesn't.
It's kind of like when people say, let's get rid of all the carbon. I'm like, so you want to die? Right? I mean, if there's no carbon in the atmosphere, then we all die. I mean, it's just a dumb statement. And the fact that really smart people say stuff like that just drives me absolutely crazy. I mean, carbon dioxide is the source of life as we know it, because we don't breathe the other gases in our atmosphere. We breathe oxygen, which has to be produced. But anyway, I digress. So I look at Bitcoin as a hedge against inflation. I look at it as running money, FU money, whatever you want to call it. It's that portion of your wealth that's outside the threat of violence, Now, the government's trying to pull it back into the threat of violence, right? I mean, Ms. Warren's trying to pass a bill that,
That
you know,
that's
make,
not, none of that's going to work. Okay,
oh, no,
it's going to be
no, it's
silly.
not, not, but she's still trying. And it's because they, when I say they, meaning the incumbents, and she's controlled by the incumbents, because that's where funding comes from, they're afraid of this, right? I mean, look, the banking industry has had a good 838-year run. Since the Medicis invented it 838 years ago, it's been an amazing run.
Yeah.
And the trust industry has extracted, you know, in today's dollars, $7 trillion a year from us to create trust. And there's some value in that, right? I mean, I actually have money in the bank, and I know it's not my money any longer, it's the bank's money. And I know that I have an IOU that I can cash in, and 99% of the time it's money good, but there is that 1% chance that I wake up in Cyprus and the money's gone. So I get that, but I don't want to keep all my money in my house, because then I'm vulnerable to other risks. See, risk is an interesting thing. Risk cannot be eliminated.
Right.
It's like energy. It can only be changed in form. You can't eliminate energy. You can turn heat energy into light energy. You can turn market risk into manager risk. You can turn physical analog asset risk. I mean, think about this. In the olden days, you and I would meet at the Buttonwood Tree in, you know, downtown New York, and we would both bring an analog thing. I would bring a stock certificate. You would bring a piece of paper money, and we would trade. And we had to be physically proximate, right, next to each other. And the problem is, on the way, if you've seen the movie Gangs of New York, those guys with the top hats could come steal our stuff because they were top. And so they're like, yeah, that's a bad system. How about we build a building and y'all electronify this? We'll put the paper in banks and DTCC, and you guys will trade electronically QSIPs. And now you don't even have to meet in New York.
Yeah.
You can be in Florida. I can be here, where it doesn't matter. And we can trade. And that's a perfectly fine system, but there's a cost, and they're extracting rents for doing that, rentiers. But now we have this system of digital where we don't need DTCC to hold the physical piece of paper. We can do away with them. We can have an entry on a ledger, okay, that is permanent, immutable, and secured by the largest computing network the world has ever seen. And I can have something of value that I can send to you peer-to-peer, which was the whole point of the white paper, with no intermediary. That's $7 trillion of the trust industry now gets liberated. Yeah. That term intentionally, okay, gets liberated. And what does it do? It goes back into the hands of human beings, and human creativity is the most powerful force in the world. Maybe compound interest is a close second, and network effect a close third, but human creativity is the most powerful force in the world. And if you give human creativity $7 trillion, which is 6 to 8% of GDP, what are they going to do with it?
Right.
Well, our technology is going to explode a quadrillion X over the next 50 years because of that. A quadrillion X. I can't even imagine that number. And things that we can't even imagine. Like if you would tell someone in the 1860s, if you've watched Yellowstone, right, that we would get on a big hollow aluminum tube and fly to where we're going instead of getting on a wagon train and risk getting bitten in the ass by a rattlesnake and dying, they would have laughed at you. They would have said you were a sorcerer, you were a witch. Well, right? I didn't take a wagon train, a horse and buggy, or an automobile or a train to go to New York. I took a plane. And that's an advancement in technology. But when my grandfather-in-law left the train company to go work for American Airlines startup, his parents were horrified.
Yeah.
And American Airlines would pass out
his career.
No, yeah, worst move of his career, right? And the train company would pass out pamphlets to people outside the grounds saying, if you get on an airplane, you'll die because your body will cave in on itself. So what are the incumbents saying today about Bitcoin? It's for drug dealers and terrorists.
Only dumb ones.
Only dumb ones, right? Because in the old days, I'm a bad guy. I meet you for lunch. I have a backpack full of money.
Totally.
And we sit down and I walk away. And you're like, hey, Mark, you forgot your backpack. I just keep walking. And you look inside the backpack. It's full of cash. You're like, oh, Mark needs me to do something. Okay, great. Not traceable. Bad guys doing bad stuff. Here's the thing. When our government sent money to Ukraine sends it to FTX on chain. FTX sends it to Alameda on chain. Alameda sends it to shell companies owned by SBF on chain. Then he makes donations, not on chain, but through checks to political candidates. Bad guys doing bad stuff. And we know, like I can actually show you those movements. I can prove, like if you looked up money laundering in the dictionary, that would be the picture.
Right.
Right. That's money laundering. So, and that's why I I used to laugh when Ms. Warren and Jamie Dimon would say, oh, it's only, I'm like, I didn't realize it was inside knowledge, right? They know money laundering. They've been doing it. And so why do they fear Bitcoin so much? Well, because it is a better form of money, one. Two, it's the most powerful computing network the world has ever seen, which can be used to replace all of the current rails that we use to transfer value. And that's the big aha. The fact that if I had a gold bar here and I wanted to break it in half, I'm not strong enough to do that, even if I could, I couldn't stuff it in the computer to send it to you.
Right.
Right. So gold is beautiful. It's the only money in the history of the world. Money is an asset that exists in the absence of a liability. Everything else that we think of as money is currency. It's backed by debt. Money, the base layer, is in every central bank, gold bars. Then they build, Fedwire, ACH, and Visa network on top of that, L2, L3, L4. And that's how we all function. Like, I don't carry money. I use this little card and I tap it everywhere. And once a month, we go from a centralized database run on COBOL at MasterCard to Fedwire, to ACH, which settles in 2 days, and then ultimately settles to Fedwire. So that's a very slow system, but it doesn't need to be fast because I only use it once a month. So the same thing is going to happen with this new Web3, where we'll all transact in stablecoins and digital assets using all kinds of data rails. But ultimately, the most valuable assets are going to settle down to this most secure, most stable asset, Bitcoin. And that's the difference between the big B Bitcoin, the token that's selling at $44,000, and little B Bitcoin, the network, which I think is the most valuable computing platform in the history of mankind. And the problem is, in the old days, you couldn't own the platform, right? You and I are using TCP/IP right now. It works great, but Zoom is the one that makes the money because we are using the application on the layer that is a public utility that you can't own. Well, now we can actually own the utility layers, and that's actually pretty cool. Now, there needs to be more dApps, digital applications. There needs to be more use cases on top of the rails, but that's all coming.
Yeah, that's right. That's right. You have to, we have hit 20 years of history to look at what happened. Like, see, to me, the allocation, I'm going to have another meeting. I'll probably come up to Chapel Hill and have you tell me why I think my allocation should be 50% of my liquid net worth. Because I don't think 3. I don't get it. I think this is one of the greatest opportunities as a commodity guy.
But the only reason and we should talk, and the only reason I would push back a little bit is, as great as I think Bitcoin is, I think the other things that will build on top of it have better return potential. And it doesn't mean
they may, but this is the only asset that I look at a 50% allocation and go, hey, I'm not sure that's stupid. I've never
I
thought
don't think,
about a
yeah,
50/50
okay,
education
that's
to
fair.
anything. That's fun.
I
It's the,
wouldn't push back on that.
it's the only
Um,
girl in the bar that you look at and go, whoa, I could live with this for a lifetime. And I'm not
yeah,
going to be disappointed long term.
yeah, I wouldn't push back on that. And look, I'm actually part of um, it's how you think about money. So all great wealth comes from concentration,
Thank you. Thank you.
right? No,
Professional
all
guy.
of it,
Here's a
all of it.
professional. Okay. All the
Concentrated
bullshit.
business ownership, concentrated stock position, concentrated knowledge, whatever, all of it, all the great wealth.
Yeah.
Okay.
That's a huge message to most entrepreneurs. Okay. They
How
think
you
they need to
get
be
rich
diversified.
is from concentration.
I know.
And if it doesn't work, you just go do something else and start again. Okay. That's how you get rich. Once you're rich, diversification is how you stay rich. Now, it doesn't mean you have to go 100, 0, 0, 100. And it probably is more like an X factor. So
Right.
you start with 100% get rich, and then you come down to some smaller number and you have no stay rich, and you come up to some higher number. And so I wouldn't necessarily push back on 50, but the problem for me right now, the average person has 0.
Yep.
So how do you get off 0? You go to 1, and then you go to 2, and then you go to 3, and then you go to 5, and then you go to 10. And just on its own merits, it'll become a bigger percentage because it's going to compound relative to the devaluing currency at a higher rate. The second thing is, if you don't have access to the venture companies, like
Most don't.
we own liquid protocols and equity. In our liquid protocols bucket, we own Bitcoin, but then we also own Ethereum. We also own Solana. We also own this little thing called the Graph. We also own a couple other DEXs. Why? Well, Bitcoin, safest, most secure. It's a later stage venture deal. We think from here, it's easily a 10x, easily, like without trying very hard.
Yeah.
And that would be roughly gold equivalents. Beyond that,
10x over what time period?
by the next halving, so 4.5 years from now.
Okay, cool. It's a good return.
So
10x
I think easy.
Yeah.
Yep. And maybe it's a little longer, but that I could see that happening easy. And from there, can it? Because that's around from here. It's about $8 trillion of value. Can it get to the 80 trillion, which would be another 10x, which would be 100x from here? If you talk to Murray Stahl at Horizon Kinetics, he'll elegantly tell you why that's going to happen and why good money will crowd out all bad money over a longer time frame. I struggle a little bit because I think the governments are not going to give up fiat very easily, but there's an elegant argument why that can occur. So you would say maybe I would say Bitcoin is more like a Series C, where I can make 10 times my money. They would say it's more like a Series B, you can make 100 times. Ethereum, I think you can make a little more, right? Because I think now, one argument, there's somebody said the other day, it's really interesting. If Solana, which says they fixed their problems, and I'll take them at their word, if Ethereum was invented today, would anyone use it when you can use Solana? I don't know, maybe. But there's actually a proposal in Ethereum to cut the transaction cost, to cut the gas fees. That will help it. So there will be technological innovation in those other L1s, but there's also an argument that says, forget it. We're just going to have one chain to rule all chains. It's all going to settle on Bitcoin, and there are going to be L2s like Lightning and L3s and L4s. And just like we have one kind of stack in regular money, but money's just one use case. We got to have other use cases that use other forms of blockchains for other things that are just better ways of organizing data. And we could spend and we'll come back and talk about what I call the ABCDs of the digital age, AI, blockchain, chips, and data on another time. But I know we both have to run and really
hey, listen, really appreciate
format.
you.
Oh, no, look, I love conversation. I love dialogue and debate in search of truth, right? That's, you know, from my good Catholic training. Although I have to give a shout out to the Jesuits, and my guys are Holy Cross, but dialogue and debate in search of truth is what it's all about. And what I think I hate most about social media and its effect on society today is it discourages debate. It discourages seeking people with other opinions. It discourages even accepting or acknowledging that those people exist. I'm like, no, come on. Let's learn from each other. Let's find out why you believe what you believe. Let's, you know, explore it, and maybe you'll change your mind. I change my mind all the time. So I think these types of conversations are important. I appreciate you having me on, and we'll do it again sometime.
Always enjoy chatting with you. Thank you so much.